Hi. Okay, we are live. Hi, everyone. I'm Caroline Zakarian, and I work for the Office of Civics and Community Services here at the Los Angeles Public Library. Welcome to Financial Planning Week. Today's presentation is brought to you by the Securities and Exchange Commission and the Los Angeles Public Library. Carol Lally from the SEC will be talking to you today about what the SEC does and how it can help to help you to invest wisely and how to avoid fraud. And please keep your questions coming throughout the program, and we're going to have a short Q&A after the session. So take it away, Carol.
Thank you. Thank you so much for inviting me to speak today. I'm really happy to be here and hope that I can provide some information that's helpful. I will, at the end of the presentation, provide contact information so you know how to get in touch with the SEC. And with that, let's get started. I'm going to take myself off camera so we can focus on the presentation, and I'll take all your questions at the end of the presentation. I do need to start with just before we really even get started, a disclaimer. We're going to talk about the overview of the SEC, some strategies for smart investing, red flags of fraud, and some common scams. And along the way, I'll try to sprinkle in some personal stories of my own experience so you can get a sense of how these principles apply in real life. And I'll provide you with some resources of the SEC at the end as well. That I think are very helpful to investors. But to begin with, let me just give this disclaimer that I'm required to give at the beginning of every presentation, which basically says that everything I say here today is not an official statement of the SEC. I cannot give legal or business advice. As I say, I'm happy to take your questions at the end. I'll answer as many of them as I possibly can, but we cannot give individualized legal or business advice. Just a little bit of background on myself. I'm an attorney. I have worked at the SEC for 18 years. I am the supervisory attorney in charge of the complaints and inquiries branch of the Los Angeles office, which means I am in charge of the group that does investor education, like we're participating in here today. And I also am in charge of the group that takes in the tips and complaints and referrals from the public and from other agencies. So I'll talk about in this presentation how to submit questions to us, how to submit tips, if you believe that some kind of scam is going on, and I'll talk a little bit about how my group handles that kind of information and what the SEC does to try to protect investors. So with that said, let's get started, and let me give you just a little bit of background about the SEC. I don't want to get too deep into this because I think probably the most relevant parts of the presentation for most people are about investing and about fraud, but it is helpful to know how the SEC fits into the investing landscape and the resources that we have. The agency has a three-part mission, as you can see there on the screen, to protect investors, maintain fair, orderly, and efficient markets, and to facilitate capital formation. We are a relatively small agency compared to the landscape that we cover. So we have about 4,500 employees at our headquarters and across 11 regional offices, which includes the Los Angeles regional office. The Los Angeles regional office located downtown, but the region that we cover is actually all of Southern California, Arizona, Nevada, Hawaii, and the Pacific Islands. So a pretty large region. The agency overall regulates more than 27,000 roughly market participants, 21 exchanges, and over 4,400 publicly traded companies. Plus, we oversee a number of other agencies and self-regulatory organizations. So a pretty big landscape that we regulate. Just about everything that we cover today is derived from the resources on investor.gov, which is the SEC's website for individual investors. So www.investor.gov. And in particular, as you can see highlighted with the red arrow on the screen, the Protect Your Investment section includes many of the resources on types of fraud, how to avoid fraud, and how to report securities fraud to the SEC. So at the end of the presentation, I really encourage you to go and check out this website. It's really pretty user-friendly and has just a ton of information on it. Is really, really very helpful. So that's a quick primer on the SEC and what we do. And now I'd like to go over some basic information on investing. A lot of people maybe don't really start thinking about investing until later in their journey. Some people, if you're lucky, start early, which is always great. And some of you may be experienced investors, some may be new to investing. But there are a lot of reasons why investing is good for you, whatever stage of your life, or can be good for you, whatever stage of your life you're in. I do want to talk by begin the talk on investing by making the distinction between saving and investing. So any smart money management begins with savings. Saving is something that you do to plan for emergencies or short-term goals, maybe purchases that you know you're going to want to make on down the line, whether it's buying a car or being prepared for car repairs or buying a house. So for anyone, putting aside enough money for a few months worth of expenditures is a good idea just in case life throws you a curveball. And if you have spent some time thinking about financial planning and your financial future, you're probably aware of the idea of an emergency fund. The Federal Reserve conducted a study that showed that nearly 4 in 10 Americans do not have enough money to cover for an unexpected expense of more than $400. This could be a minor car repair or even a cracked screen on your phone. And for these people, even a small financial shock can turn into long-term debt if you don't have an emergency fund. So an emergency fund is really the first step in planning for your financial future, setting a savings goal of putting aside some amount out of your paycheck or whatever source of income into a savings account, and taking advantage of opportunities like tax refund or gift money, those one-time opportunities, and putting them into a savings fund, working towards that goal of building up a few months worth of living expenses so that you have an emergency fund. And that makes it a lot less likely that you will go into debt if life throws you a curveball. So that's kind of the first step of any sort of financial planning. But saving is not the same thing as investing. Saving is the money that you earn but you don't spend. Investing is a little different. Investing is making that money grow. And the key difference between the two is that investing has risk, but it also has the potential to earn higher returns. So if you save your money in a federally insured bank account, like a money market bank account or a savings account or a checking account, that's a pretty secure place to put your money. As I say, a lot of those kinds of accounts are federally insured up to a certain dollar figure. Investing has risk and has the potential for loss. That is why your bank pays a relatively low interest rate to keep money in a savings account, maybe 1%. But it's safe because it's FDI insured. Investing is not FDI insured. You are going to take on more risk when you invest. Knowing that you're going to take on more risk, why would you want to do that? And the answer, in a nutshell, is inflation. You can't just stick money under the mattress because the money you have today won't have the same purchasing power for what you need later on. The costs of goods and services go up. As you can see on the slide, here's an example of the cost of a car over roughly a 25-year period has gone up over 100%. So if you put aside for purchasing a car $25,000 in 1995 with this idea maybe you're going to purchase a car for a child 25 years down the line, and you didn't put it in an account that earned a reasonable return, you would find that $25,000 didn't go nearly as far in today's market. Certainly, I'm finding that out myself. I was in a car accident actually a couple of weeks ago, lost our car, and it is not a good time with the pandemic to be buying a car. And this is why we can't just save. We can't just put money under our mattress. We have to think about how are we going to make our money grow to keep up with inflation. How do investments keep up with inflation? What makes it different than savings? It's through the power of compound interest, growth over time with the power of compounding. Compound interest is the interest that you earn on interest. Not only does the money in the account earn interest, but the previous interest itself earns interest, and that interest then earns interest, and so on, basically a snowball effect. So imagine that at 25 years old, you made a one-time investment of $1,000 and did not touch that account again for 40 years. Thanks to the power of compound interest, if you check that account again at 66 years old, your money would have grown to roughly $15,000, assuming a 7% annual interest rate, which is a pretty reasonable assumption given the historical averages of the large US stock market. So by starting early and using the power of compounding, you're putting your money to work for you. But the number one rule of investing is that all investments have risk. If you're a long-term investor in the US stock markets, you historically have done well, but all investments have risk. And this is the big difference between saving and investing. So before you go down the road of beginning your investing journey, you need to figure out how much risk you're willing to take on. That's called risk tolerance. Different investments have different risks, and the potential for a greater return typically comes with higher risk. Those are correlated. So if you move from safer but lower potential return investments like cash towards riskier investments, more potential for loss, but also more potential for returns into bonds. And then the riskiest, most broad general investing class, stocks, which have the highest risk of loss, but have also the highest potential for returns. Before you start your investing journey, you need to understand and have a good sense of what your own risk tolerance is and how you would want to allocate your own investments across the spectrum of risk and potential return. This next slide shows those same investment options in a little bit more detail. So cash includes cash equivalent investments like CDs and money market funds. Again, these have a lower risk of loss, but potential for much lower returns. Stocks historically have offered the greatest potential for growth, but also have the greatest potential for loss. So this is a general sense of the risk level of different categories of investment. How do we manage the risk level so that we can get comfortable with our own risk tolerance and what's appropriate for us? The best way to manage risk is to allocate your assets and diversify your investments. So in other words, put your money in different asset classes, and within different asset classes include different investments. So if you're investing, for example, in stock, you might want to invest in both domestic and international stocks. You might want to invest in both large cap or large companies and small cap companies, so that if one investment performs poorly, another might do well. In other words, you're going to follow that age-old adage, don't put your eggs all in one basket. Mutual funds and exchange-traded funds, or ETFs, are a way for individuals to invest in the markets without purchasing individual securities. Lots of workplace retirement plans like 401ks offer a selection of mutual fund investments to employees. And the benefits of these mutual funds and ETFs are that they're professionally managed. Fund managers do the research for you. They select the securities. They monitor the performance. They're diversified. They're going to achieve that goal of don't put all your eggs in one basket, because mutual funds typically invest in a range of companies and industries, and this helps lower your risk. If one company fails, in most situations, there will be another company in the portfolio that is doing well. Ideally, that's the idea behind mutual funds. They are affordable. Most mutual funds set a relatively low dollar amount for initial investment and for subsequent purchases, and they're liquid, meaning that you as an investor can easily redeem or sell your shares at any time, usually for the current net asset value minus any redemption fees. So basically, they're easy to sell if your situations or your investing risk tolerance changes. Even in a mutual fund or an exchange-traded fund, there is going to be risk. All investments carry some level of risk, but typically in mutual funds or ETFs, that's going to be the same as the underlying securities. So just to break it down a little bit more, the way mutual funds or ETFs diversify is by holding many different stocks, bonds, or securities. And again, this diversification helps because if one company or sector experiences a decline in value, others may post gains. This slide here shows the S&P 500 stocks over a single day. So this is actually a snapshot of an actual trading day, a particular point in time, showing each of the 500 stocks that are tracked by the S&P 500. And you can see their ticker symbols here up in the top left-hand side. You see the Google ticker symbol. Sort of in the middle bottom, you can see Apple. There's Amazon up at the top. Over on the left-hand side, we have the financial sector with JP Morgan and Bank of America. So these are all of the 500 stocks that a hypothetical S&P 500 index fund might have in its portfolio. What you can see on this visual is that certain sectors are having a down day. So in this particular day, on the bottom left-hand side, you can see the financial sector. These stocks are having a not good day. These are why they're in red. They're either flat or they are declining in value. While you can see over on the far right side, biotech is having a largely good day. Those stocks are green, meaning the value of those stocks are going up. So even if you have one sector that's not performing well, by being invested in a mutual fund, you're diversified, and hopefully the sectors that are doing well compensate, and more so for the sectors that are performing poorly. Another thing to think about is if you had to research and purchase all of these 500 stocks on your own, that would take quite a bit of time and also money. Just imagine having to research 500 different companies and then make adjustments as you go along. I want more of this stock. I want less of this other stock. Each time you buy or sell, there's a transaction cost. It becomes very both time and money intensive in order to do that kind of work. A fund is going to do that work for you, and the transaction cost will be much, much lower. So it just makes it a lot more feasible and a lot more affordable for the individual investor. Just in case you're curious, this particular snapshot was taken on January 6th, 2020. So this is a snapshot of how the stock market, the S&P 500, was performing on that day. There are basically two types of funds that you can invest in. Actively managed funds are funds that rely on the skill of an investment professional to buy and sell securities, usually in an attempt to outperform the market. An index fund is also what's sometimes known as a passive fund, and it is exactly as it sounds. It's a more passive strategy that attempts to match the performance of a specific index or benchmark, like the S&P 500 or the Russell 2000 index, rather than try to beat it. Now, when you say that, the first thing I think most people think is, why wouldn't I want to try to do better than the specific market index or benchmark? And of course, we all would love to do better. Everybody likes more money. I think that always sounds like a good idea. But this isn't, it might seem at first blush like that is the best way to earn more money for yourself, but that isn't necessarily the case. Actively managed funds may have higher fees, and if so, they will need to have higher returns in order to make up for the higher fees and then give you the same amount of return as the index fund. Or if you're trying to beat whatever the index fund is making, it's got to be yet again even higher to get that higher return, plus to cover the fees that they might charge. Fees are very important. It's not a very exciting topic, but they're very important, and they can impact your investment return. You should research and think about them before committing to any investment. And that is one of the things that very frequently makes something like an index fund or a passive fund an attractive choice for a lot of individual investors. The fees tend to be quite a bit lower than they are in actively managed funds. Just to give you a sense of how big of an impact these fees can have on your portfolio, we have a bulletin on investor.gov that shows this exact chart that's here on the screen that shows the impact of various fees on a $100,000 investment over 20 years. So what this graphic tracks is a $100,000 investment made by 3 individuals into the same investment product. And that money just sits in that investment product for 20 years. They don't touch it. They don't take it out. But that investment product is held in 3 different funds. So the person who is in the investment product in the fund that is represented by the green line is paying a 1% annual fee to that fund. The person with the red line is paying a 0.5% annual fee, and the person with the blue line is paying a 0.25% annual fee. So even though they're holding the exact same investment, the fact that that investment is in different funds with different management fees has a pretty profound impact on the returns that they see at the end of 20 years. Now, you might say to yourself, the difference in fees is relatively small. We're only talking about a 0.5 percentage point or maybe 0.75 percentage point. That doesn't sound like a lot. But those relatively small differences add up to tens of thousands of dollars over 20 years. And then the person who's paying the highest fee ends up with $180,000 from their original $100,000. So $80,000 more, that sounds great. But the person with the lowest fee ends up with almost $210,000. So almost $30,000 more by virtue of paying that lower fee, even though the percentage difference in the fee is pretty small. It really does have quite a big impact over time. So it's one of the most important questions to ask yourself when you're looking at an investment product. When you want to compare the fees and expenses of various funds, FINRA has a free tool called the Fund Analyzer on its website, finra.gov. And here you can see right here at the bottom of the slide, finra.org. Finra.org, you can just put in the search tool on finra.org, Fund Analyzer, or you can put in the full address as you see here, Fund Analyzer. And up will come this search window to put in the name of several different funds that you can then compare and contrast against each other. So if you know 3 or 4 different funds that you might be interested in that you think might meet your investment goals, put them in and you'll get a lot of different information about the funds. There are more than 30,000 mutual funds in this database, and the information will include the fees that they charge, which is an important component of what you should be thinking about when you're making an investing decision. And here are some of the questions you also might want to ask yourself in addition to the fees themselves, whether or not the mutual fund or the exchange traded fund meets your particular investment goals. How does that fund match your goals? What's the fund's performance over time? How does that compare with my risk tolerance? Again, the fees and expenses are very, very important. And will the fund help me diversify my investments? If you are interested in investing in mutual funds or exchange traded funds, there's a lot of information, much more in depth than what I've talked about here today on investor.gov. And I really encourage you to go to the website and take a look at those materials. They're really very helpful. Now that we have sort of the basics of individual investing out of the way, let's talk about fraud, because unfortunately, fraud is really quite prevalent. A survey by the FINRA Foundation found that 8 in 10 respondents were solicited to participate in a potentially fraudulent offer. 16% of all the respondents had invested money in response to at least one of the fraudulent offers, and over 11% of the respondents had lost a significant amount of money after engaging with an offer. As you can see on the slide, fraud costs Americans over $50 billion a year. So really a pretty significant problem. And unfortunately, I can say my own experience, before I was the supervisor of the group that handles outreach and taking in the tips and complaints, I worked for 10 years in the Division of Enforcement, which is the part of the SEC that investigates and prosecutes securities fraud. From both of those positions, I can tell you that unfortunately, fraud really is quite prevalent, and it's really important for all of us to be on the alert. And here are some red flags of frauds you should keep an eye out for. Many scams sound too good to be true. If it sounds too good to be true to you, trust your instincts. If the offer promises high returns with little risk, it's probably a scam. As you saw on the earlier slides, risk and the potential for return are correlated. So if something is relatively low risk, it is going to offer relatively low returns. It doesn't take a very high return to induce people to invest in something that is not very risky. Once things become more risky, it is that potential for high returns that will encourage people to invest in, and it will cost more money to borrow money from a bank or those sorts of things if you're engaged in an enterprise that's risky. So the business itself will have likely higher costs associated with it. So whenever you see something that is offering a potential for a high return, or even worse, is guaranteeing a return. Guaranteeing is a huge red flag. There's no such thing as a guaranteed return. Anytime there is some high return, you should immediately be alert, because if nothing else, that indicates that it's a very risky investment. Just by way of reference, over the life of the modern US stock market, roughly the last 100 years, the stock market has averaged 7 to 8% return. So once you get outside of that territory, it starts to be a much riskier investment. Don't be pressured to buy right now. No legitimate investment requires a quick decision, so you should wait until you have time to do your own due diligence. Watch out if there's no prospectus or offering memorandum or statements or any kind of documentation about the investment, and make sure that any investment professional you use is licensed and registered. And I'm going to show you how to do that. So lots of times when I talk about securities, people's first thought is, of course, usually something like stocks or the New York Stock Exchange, or maybe they'll think about bonds. But a security, the legal definition of a security is anytime there is an investment of money into a common enterprise. So you and I pool our money together to invest into something, and we are expecting that that enterprise, that business, is going to generate profits to us. But we're not going to be actively managing the business. We're going to be passive. We're expecting other people to run the business and generate those profits and pay them back to us. If you've got those sets of factors, you've got a security. It doesn't have to be traded on the New York Stock Exchange. It might be something as informal looking as an investment agreement, and that could still meet the legal definition of a security. But the farther you go away from formal documentation with detailed prospectuses or public filings with the SEC, the more likely you're entering into not just uncharted territory, but potentially fraudulent territory. And you should be really, really cautious if the investment is not accompanied by pretty detailed documentation. Another red flag of fraud is an unsolicited offer to invest that comes out of the blue. Tread carefully when you didn't seek out the investment or the salesperson. Do your homework if you're tempted by the offer, or better yet, walk away. Because the best scenario is to do your own research and choose where to invest. And then I do want to talk a little bit about market timing, because that's been a big focus of commentary in the media generally, and then on social media recently. So be very cautious, I would say, in market timing. A Library of Congress study on investing behavior showed that active trading generally results in underperformance. And there are a few reasons for this. First, investors tend to hold on to losing investments too long and tend to sell winners too soon. All of us also have a tendency to follow trends and overreact to good or bad news in the market. And you can also be charged a fee each time you buy or sell. So even if the investment is doing relatively well, those fees that we talked about or transaction costs can reduce your long-term performance. Picking only a few stocks that you hope will be winners can leave your overall portfolio with very little diversification. And if you move money in and out of the stock market, keep in mind that studies have shown that missing even a handful of the best days, market surges, can severely impact your long-term returns. Having a low-fee, diversified, long-term buy and hold strategy for most people better assures you of capturing the market's best days in any given time period. That's the best strategy for most individual investors. Now, again, I cannot give personal, business, or legal advice. You have to decide what's the best strategy for you. But for most individuals, that low-fee, diversified, long-term buy and hold strategy is what works best for them. And remember that there are other ways to participate in the market without attempting to pick winners or time the market. And that is investing in a diversified portfolio like a workplace 401k, mutual funds, or ETFs, and sticking with them through the market ups and downs for the long haul. If you're thinking about investing in the latest hot stock, think carefully is what I would say. You might try to profit from volatile markets by buying individual stocks, including stock in heavily promoted companies. They might be discussed on social media and online message boards, but following the crowd can lead to significant investment losses. Understand that all investments have risk, and short-term investing in a volatile market can lead to really very significant and unanticipated losses. In particular, using margins, options, or short sales may magnify these risks, and you can lose more money than you've invested. Also, brokerage firms may be able to reject or limit your transactions for legal, compliance, or risk management reasons. And in certain circumstances, broker-dealers may determine not to accept orders when a transaction presents certain associated compliance or legal risks. So this is really a very risky area of the market, and you should proceed with extreme caution in margin options, short sales, short-term trading based on social market promotions in volatile markets. These are all really extremely, extremely risky. Proceed with caution unless your own risk tolerance is really extremely high, and even then proceed with, I would say, a great deal of caution. And finally, understand that fraudsters use online platforms to spread false or misleading information in order to manipulate companies' stock prices and profit at investors' expense. So just because you're reading something on social media, you have to be really very skeptical of the motivations of the people on the social media platform and also their own knowledge and expertise. Here's some tips for investing wisely for the long term. Know your time horizon. When is it that you're going to need those funds? Are you investing for retirement? Are you investing for purchasing a house or financing someone's education? What's your time horizon when you're going to need that money? And keep those objectives in mind. If you're going to need the money relatively soon, your risk tolerance is probably a lot lower than somebody who doesn't need the money until 40, 50 years from now. Don't let short-term emotions get in the way of your long-term financial goals. And just to back up, that's because you don't have as much time to make up losses. So if you incur a loss, but you're not going to need the money for another 40 years, you hopefully got time to make up those losses. If you're going to need the money in a year, you don't have a lot of time to turn things in your favor. So that's why it's really important to know what your time horizon is. Don't let your short-term emotions get in the way of long-term financial goals. Real-time discussion platforms sometimes lead people to make emotionally driven or impulsive investment decisions. So be really very careful. Take your time to do your own independent research. Let's talk a little bit about some of the common scams that fraudsters run. One of the most common is pump and dump. This is a type of fraud that typically involves the cheapest kind of stock called penny or microcap stocks. These are stocks that are quoted at under $5 a share. Probably, not always, but probably not traded on something like NASDAQ or the New York Stock Exchange, but just quoted over the counter. Promoters often hype or pump a stock to attract investors, and as investors buy the stock prices go up. That's when all the promoters sell or dump the shares, and then the share price plummets, and you and I, the ordinary investors, are left with worthless stock. If any of you saw the movie Wolf of Wall Street, that's what that kind of scheme is. Ponzi scheme, very often at first glance, looks like a legitimate investment, but lots of times these scams promise unrealistically high or consistent, like the same return year after year after year returns. They might be using money from new investors to pay promised returns to earlier investors, or they might not be investing at all. They might just be financing their own extravagant lifestyle. This is an area where that red flag, if it sounds too good to be true, if they're promising high returns with low risk, you should be very wary. And very often this is accompanied by securities that are not registered, do not have a lot of documentation. The sellers themselves are not registered, and very often use salespeople who have themselves been duped. Pyramid scheme is a similar sort of scheme. People often get the term Ponzi scheme and pyramid scheme confused, but a pyramid scheme is marketed as if it is a legitimate multi-level marketing opportunity, but really in a pyramid scheme, the focus is primarily on recruiting others to join for a fee, as opposed to a particular product or service. And be skeptical if you will receive more money for recruiting others than for product sales. Or if the company promises easy money for no work, those are big red flags of a potential pyramid scheme. Ask to see the financial statements audited by a CPA, showing that the company generates revenue from selling its products to people outside of the program. If they can't do that, more than likely it is a scheme. Let's talk about one example we see in the digital asset space. So in February 2021, the SEC brought charges against 3 individuals for defrauding hundreds of retail investors out of more than $1 million through 2 fraudulent and unregistered digital offerings. According to the SEC's complaint, the promoters induced the investors to buy digital assets by falsely claiming the company was the largest Bitcoin exchange in euro volume and consistently related the best and most secure Bitcoin exchange by the media. The promotional materials also falsely claimed that the tokens would be deliverable on the Ethereum blockchain and would be mineable and tradable. But in reality, the SEC alleged the offering was a sham and the promoters misappropriated millions of dollars of investor funds for their own personal benefit. I would just say if you are interested in investing in the digital asset space, again, you should be very, very careful. Every time there is a new development in a market that does bring the potential for some exciting and potentially rewarding investments getting in on the ground floor, but it also tends to bring out the fraudsters because it's new. People don't understand it as well as a well-established industry, and the fraudsters will smell an opportunity. This is an area in which we get just dozens of tips all the time. And if people are promoting that they're building a big mining enterprise where they're going to mine through blockchain technology using servers that are based in, let's say, Malaysia, how are you going to verify that that's where your actual investment funds are going? Pretty unlikely you're going to get on a plane to Malaysia, especially during a pandemic, and go see the actual computers and servers that are processing all the mining. So this is an area that is ripe for fraud. Not to say there aren't legitimate investment opportunities in this space, but it is somewhere that you need to really think very carefully. One type of fraud that's especially vexing is when the seller has a connection to the group that he's targeting. We call this affinity fraud, and it's where a member of the community of your same cultural or racial or ethnic or religious community seeks you out, hoping to use that affinity, that connection between you, as a way to scam you. Here again, the same rules apply. You need to check the background of any seller before you invest. Even if you go to their place of worship or live in their neighborhood or share their background, you should always research the investment and the investment professional. And remember that the person who is trying to sell the investment product to you may themselves have been scammed. And unfortunately, anybody and everybody is targeted by scammers in affinity frauds. So whatever groups you are part of, or whatever way in which you identify yourself, more than likely there's a fraudster out there that is part of your community that is targeting you and other people in your community. So be careful. Run through the same kind of background steps no matter where the investment opportunity is coming from. So let's talk about what those steps are. The very first thing to do to protect your hard-earned money from investment scams is by making sure that you're dealing with a licensed or registered investment professional. Before you use an investment professional, including anyone selling you an investment, even if you know them, make sure you check them out on investor.gov. You can go to investor.gov, and as you can see on the screen on the landing page, the very first thing you will see at the top of the page is this search tool, check out your investment professional. Type their name into that box, and it will show you whether or not they are licensed or registered. It will also show you their employment history, firms that they've worked for, how many years experience they have. If they're jumping from firm to firm, this can be a pretty big red flag. And you'll also be able to see disclosures if they have any, which will show things like, have they been sued by the SEC? Have there been litigated or arbitrated customer complaints against them? Very helpful information. The very first step you should take when you're dealing with any investment professional. But in addition to researching the people who are trying to sell you something, you want to do research on what they're trying to sell you, the particular investment you're considering. So on the SEC's website, and this is easier to access on our website, sec.gov, we have a tool called EDGAR, and the search bar for that is at the top right-hand side of sec.gov. And this will allow you to research publicly traded companies, mutual funds, variable annuities. It is our online database of all corporate filings, and you can learn a lot of important information from these filings that the companies are required to provide to the SEC and thus make public to the public. This is also critical because lots of scams involve unregistered companies. So if somebody is trying to get you to invest in the stock of XYZ company and you put XYZ companies in this EDGAR search tool and nothing comes up, that's a pretty big red flag. EDGAR looks like this, and once you type in the name of the company, you can see filings including the registration statement and the periodic disclosures with the SEC, financial information, stock holdings of the officers of the company, and the company's audited financials. And we do have, as you can see here, a guide on how to use this information to research companies' operations. So if you're a little daunted by this, or it seems like a lot of information, don't worry, we do have guides to help walk people through this, and you can see right there, learn how to quickly research a company's operations. Here's some other things to remember so that you don't get scammed. The government doesn't call you to collect fees or get your personal information. If somebody calls claiming to be from the government and you didn't initiate the contact, hang up the phone, call whatever, go to find the local office number for whatever agency claims to be calling you, and call that main public number and find out if that individual works there or if the agency tried to reach out to you. Don't pay for investments with credit cards or gift cards or wire transfers. If you don't recognize the caller, don't pick up. That's good advice, I think. We've all hopefully learned from being at home so much during the pandemic. There's a lot of robocalls and all sorts of things coming to our house. Don't pick up if you don't recognize the caller. If you choose to speak with them, at least don't share your personal information. Don't pay a fee to claim a winning or any other sort of proceed. That is not how legitimate lotteries or investment opportunities work. That's a particular kind of scam called an advance fee. You pay that processing fee or shipping fee to get whatever reward amount of money, valuable item they're claiming to send to you, and you will never hear from them again. And if they get enough people to send them the $20, $50, whatever processing fee, that's a lot of money for them. And you're never going to see that money again, and you are not going to see the $1,000 winnings or proceeds or whatever it is that they are offering to you. People make it seem like building wealth can be quick and easy, but it is not. It takes a sustained commitment. Slow and steady is what wins the race. So just to recap, here are the three main tips of how to protect yourself against fraud. Be aware of common persuasion tactics and red flags. Be alert to common investment scams, and research both the financial professional and the investment product. And then I'll just close by sharing generally our resources. Again, investor.gov. This is a really helpful website, lots and lots of information. So if you are interested in a particular product and you go into Introduction to Investing, you'll be able to find something on mutual funds or ETFs, or you can just use the search tool up here, search investor.gov, or down here under investment products, there'll be more information. It doesn't show up on this slide, but if you scroll down just to the right under the top of the landing page, there will be something that says submit a tip or complaint. So if you are concerned that you have been the victim of investment fraud, I would really encourage you to submit a tip or complaint through that online portal. Every tip that we get, whether people call us or write us, has to go into this database, what we call our TCR database. The tip or complaint portal on our website is a direct link to that database. So your tip goes right away into the database, and attorneys and paralegals at the SEC begin looking at it immediately. And that does not mean that every tip or complaint that we get turns into an SEC case. It does mean that it gets looked at very closely. Sometimes people submit things that don't fall within our jurisdiction. We'll share them with another federal or state or local agency if they fall under another agency's jurisdiction. But I can tell you that they get looked at, and a significant number of our investigations come from the tips and complaints that people provide to us. Just by way of background, there was not a slide on this. So the Division of Enforcement is one of the divisions of the SEC that goes out and investigates and prosecutes. That division goes out and investigates and prosecutes securities fraud. And even though it's a civil agency, lots of times people think we're a criminal agency. We're not. We're a civil agency. We have very broad civil remedies, including being able to take control of assets, repatriate funds from overseas, put receivers in place over businesses, return funds to harmed investors. And we work very, very frequently with criminal authorities like the FBI or Homeland Security, and they may be doing their own parallel criminal case where we will try to get someone barred from the industry if they've been engaged in wrongdoing, and they may end up getting prison time for the individual. So that's my presentation. I have the contact information for the SEC more broadly, and then you can see here at the bottom, the Los Angeles office of the SEC, you can reach by emailing losangeles@sec.gov. The SEC is on Twitter, it's on Facebook. As I said, please check out investor.gov. It's really a very helpful website. And here you see main contact information for our investor assistance group. And now let me put myself back on camera, and I'm happy to take any questions that you might have.
Great. Thank you so much, Carol.
Sure.
Hi, I'm Madeline, and I also work in the Office of Civics and Community Services here at the Los Angeles Public Library. That was super informative. There's so much to be aware of, and thank you for taking us through all of that. I do have a few questions for you. Can you let us know what the difference is between a securities broker and a securities investment advisor?
Sure, happy to answer that question. So both of these individuals or entities, because there are broker-dealer entities and investment advisor entities, provide services to people who are investing, but the services that they provide are slightly different. And one of the ways in which you can tell is how they are compensated. So a broker or a broker-dealer is typically compensated by a commission. So if they will buy or sell securities on others' behalf, and then they will be paid some sort of commission based on that transaction. An investment advisor is usually compensated by being paid a percentage of assets under management, and they are providing investing advice for someone or a fund. So very typically the way people might engage with an investment advisor is they are invested in a fund that perhaps has been recommended to them by an investment advisor, and that investment advisor is then paid by the fund to manage the fund and make investing decisions, and will be paid some percentage of the assets under management by the fund. That's the difference between the two. But both of them should be registered and licensed. So a broker-dealer will be licensed by FINRA. An investment advisor will be either registered in the state or the SEC, depending on how much money they manage. But both of them should be in that database that I showed you in the presentation.
Great, thank you for that. And then how have social media investing apps affected individual investors?
So I talked about that some in the presentation, and I think there are kind of both pros and cons. I think that has opened up to a lot of people the idea that securities investing is not just for the rich, and help them maybe understand that investing for your future is something that we should all be thinking about, all be planning for retirement, even starting at an early age. But as I talked about in the presentation, the downside of that is sometimes what you see is this gamification of people's investing behavior, where instead of planning for that kind of long, slow, steady climb to your ultimate financial goal of usually retirement or some kind of long-term purchase way off in the future, people are become very active traders and might be incentivized to trade based more on impulse, which can really be quite dangerous and quite expensive and harmful for people. So you really do have to be very careful if you're going to participate in the market in these ways. Again, do your homework, think very carefully, and don't make impulsive decisions.
Thank you. That's always wise advice, right?
Yes.
And then
Advice to follow sometimes, but usually good advice.
always needs to be repeated. And I think you covered that in your last slide, but the best way to contact the SEC, is that through a local office?
So you can contact us any number of ways. You can certainly call us. I'll tell you that I had on the slide the number for the Investor Assistance Office in DC. You can certainly reach out to us in the Los Angeles office too. Our main number is 323-965-3998. You can email us at help@sec.gov. Again, that goes to the main Investor Assistance Group in DC, or you can email us at losangeles@sec.gov. But quite honestly, really the best way to contact us is through the internet. If you have internet access and you are comfortable using it, I really encourage you to do that. If you go to investor.gov, you scroll down just past the beginning of the landing page on the right-hand side, where you can submit tips, complaints, questions. There will be a form. It's really very easy to fill out. And as I say, automatically it goes instantly to the staff of the SEC, and we start looking at it. Everything that we get, if we get a phone call or an email, we've got to put it in that database. So it's really actually kind of saves you a step. I know sometimes people don't like to use the internet, but if you're comfortable using it, it really is the most efficient way to do that.
Cool. That's also helpful to know. So thank you very much. Okay, so this concludes our presentation tonight. Don't miss tomorrow's program on Wednesday, October 13th at 6 p.m. from the Financial Planning Association, Investments, Breaking Down the Investment Universe. Have a great evening, everyone.
Thank you. Thank you so much.
You're welcome. Thank you.